Just because the market is struggling doesn't mean we need to struggle. Hey everybody, this is Spooky's Revenge. We're back with another delayed episode of the $500 5-year Rags to Riches series. Episodes? Sorry, I just got back from an appointment. So let's dig right in because I just want to show you guys all the things. So first off, one thing that I'm going to point out here is that you can see that this portfolio is not at break even. And that is something that we don't often see shared on a lot of these, account follow-alongs, the ones that we do see. Most of the times they would like add extra money in and bring it back up to par, right? So I'm just showing you guys everything. So there's nothing that I hope this shows that, if you're having drawdown, you're not the only one, right? But that doesn't mean that we can't make the best of a rough situation, right? So yeah, first off, it's like $1,000. I'm not worried about it. But that doesn't mean we have to enjoy it. That's 2% of the portfolio. So, and I have all this equity. All this stuff is tied up in stuff, which is pretty cool because all that has to do is just start coming back, right? And then all that's additional profit on top of our base. So, for example, this 12K right here on Neo, as soon as that comes back to break even, that's 12K added into the portfolio. So I'm okay with that. But that's not what I want to talk about today. Today, I want to talk about a strategy that we used to use, and I still use for my speculation trades that kind of forces us to ignore FOMO, right? It forces us to kind of put time to the side, and it really, really thrives when there's volatile market conditions. Like right now, we're having super volatile market conditions. However, when the market isn't volatile, when things are flat, that's when we kind of see some, not necessarily bags, right? Because our average is always right there or nearby, right? But it does tend to struggle a little bit as far as locking profits, freeing up capital, and moving into the next trade. So I personally have just been doing these on the morning runners all last week. And then this week I've just kind of gotten back into, catching them on the way up and then on the way down as well, just because I want to show you guys how this all works. And so first off, let's get a sense of the market. So if we look at SPY, I'm just going to kick this up to the 30-minute. You guys can see that we've been in a pretty stable downtrend. So we kind of identified a rough area back here, and then we kind of identified the peak after the fact, right? After it sold off, we're like, okay, that's probably going to be the tippy top, right? For a while, because the support level here just got blasted through. There was nothing to hold that up, and then it tested as a resistance, and then it sold off even harder. So it's going to take a lot to challenge that high. We attempted it here, and then just got a bloodbath on the 4th. So the market has to want to come back. So we can't control that. We can't control what direction the price moves. All we can do is make a plan, okay? And to make a plan, you got to kind of know where you're at. So in this case, all right, given the fact that the market has just been blood, and we've got JPOW butting in and delivering some kind of negative remarks on some things, it's not really putting a lot of confidence in the market. So when it's raining, we can put out our buckets in an appropriate way. Okay, and the strategy I'm going to walk through here is to teach you guys how to do that in a relatively healthy way. There is still some risk, obviously, because you are still dealing with drawdown, so I don't want anyone to think this is a foolproof plan. But it is probably much safer than what 90% of the market's doing in conditions like this, right? So we know that the first opportunity is to place a buy, pick a pattern like an engulfing candle or RSI cross-up or a moving average cross up or whatever your strategy is, right? You should have defined risk based on that strategy. So in my case, bullish engulfing, I use the lower of the two candles, and that determines where my stop loss should be. If, however, the price doesn't go up and I don't want to stop out, let's say I buy just a small piece of what I intend to put into a position, and the price goes down, I can still trade that position. I can still manage the position. So what we're going to do today is I'm going to talk about some rules that I use, because once people find out that they don't have to put 100% of their money into the trade right there and hope they're right and then have that 33% chance of being right at best, it changes things, right? If you know that you can take that same amount that you would have put into that stock and break it up across maybe 3, 5, 7 buys, 10 buys even if you wanted to, you're essentially just giving yourself more opportunities for that quote unquote entry to go up, because you're taking more entries with the same overall dollar amount, and it's cool, right? So obviously the big risk here is that if the price just continues to sell off and the stock gets delisted, you lose what you put in, right? Which is why we're going to put some rules in place to force us to slow down when it comes to placing those buys, because first thing people want to do when we tell them, like, hey, you could put a quarter of your money into this here. You could put a quarter of it in when it moves down a little bit, when you see it start to pull back up, and then you can put the remaining 50% in when you're, when you're confident, and then you can set a stop loss. First thing they do is they put all three buys like within 10% of each other. And all that does is still takes all your money and still puts it in that same range. And then you're kind of stuck. Okay. So we can force ourselves to respect some rules and some boundaries here, and we can stretch that out a little bit. All right. So I'll just walk you through the closed orders for PXMD really quick. Let me just change that just to PXMD. And I'll walk you guys through how I do it. Okay. So first off, I'm using $1,000 for the first buy. All right, the total position planned is $16,000. Okay, and what I do is I take 1/16 of that, so not a huge piece. All right, just taking $1,000 and I'm putting it into the stock where I see it's appropriate. Okay, and then I immediately set a 10% sell order. Okay, and that's what I did here on these first two. I bought at 99 cents and I sold at $1.09. That's 10% profit. Very easy, very fast. Okay, if the price goes down, however, I'll place a second buy when certain conditions are met, certain criteria, and I'll walk you through that in a second. And I use a specific type of order when I do it, and I'll walk you guys through that from start to finish. So right here, for example, I bought $1,000 worth at $1.12, and then the price went down. Okay, price went down, my criteria was met. I bought another buy, same size, $1,000. So at this point, I'm $2,000 out of $16,000 in. Bought that second batch of $1,000 worth of shares at 94 cents, and then the price went back up, and I sold it at $1.13. So the first trade, since it's 10% and it's a $1,000 buy, it's a $100 profit. Okay, so I locked in $100. Second one, from here to there, two buys is $200 worth of profit because I'm putting in $2,000. Okay, $2,000, 10% is $200. So between these two trades, right, first buy and sell, second set of buys and sell, that is $100 plus $200. Okay, so $300 total so far, up to here. And then I placed buy. The price started at $1.06. I bought some more at 85 cents or 84 cents. And then I accidentally got filled again at the same level just because I wasn't paying attention. Price went back up, and I reduced that position at 91 cents. Okay, so that's roughly around my break even at that point. And then the price went down to 68 cents, right? Because again, we don't have to buy just because the price goes down. We really want to see specific things that give us a high degree of confidence that the price is likely to push back up, right? We don't want to catch it on the way down and hope we're right, because you're going against the trend at that point, and that's kind of silly. Okay. So in this case, I bought more at 68 cents, and then I bought more at 57 cents, right? Because again, I'm just looking for specific criteria. And then the price recovered. It went back up to 77 cents, and I sold everything, right? And I think that was like a $500 position right there. And then I bought more. I bought another $1,000. So that first buy, right, the initial position size, I bought at 82 cents. I bought the second one at 68 cents because, again, the price went down, came back up, showed me my specific criteria that I look for. And then I sold at 81.76. And then today I got back in 83 cents. And I'm just going to rinse and repeat this. You can see I've got my sell order in place here at 10%. And I've got a threshold right here where I'm going to look for that criteria that I like to see. Okay. So my criteria is very simple. And this is where people tend to overcomplicate things. First, I want the buys to be at least 10% apart. Okay. And I'll show you a spreadsheet that I worked on that kind of shows you exactly how to calculate this. So if I place my buy here at 0.8334, right, 83 cents, and I move down at least 10%, okay, that's a fixed range, okay, and this range right here is going to serve as my protection block, my FOMO protection block, all right? So I'm not going to buy anything until it's below this threshold, right? So this is my zone of opportunity down here. So anything below this line is where I'm going to start to look for my criteria, okay? So if price shoots down, I don't see my criteria, price shoots down some more, I don't see my criteria, and then it shows it here, right? Even if it continues to pull down, right? Let's just say it does show it there, so on and so forth, right? This right here would just be my second buy, okay? What I'm not going to do is I'm not going to buy it just because it hit this level, right? That's like buying a Fibonacci just because it hit the 50% line, okay? we can be a little bit more effective and a little bit more efficient, especially in this kind of market. You kind of have to be. So let me just erase all these lines, and I'll walk you guys through how specifically I do things. So just going back to this example here, let's say our buy was right here, okay, at this level. All right, let's say we had the price pull down below this 10% threshold, and we saw the criteria that I like to look for, okay? And then I decided it's time to place my second buy, okay? And I planned 7 buys total for $16,000 total. So my second buy, first, second, and third buys are $1,000 each. The next 3 are $2,000 each, and then I have a $6,000 reserve just in case I need it, right? But I usually don't. So, so let's just say this is where I place my second buy. Now, I'm not going to use the next, I'm not going to stack these up and then, place another line here and then stack this up here and place another line here, because it's not really efficient to do that. But what I can do is I can take my initial buy and I can set a threshold, and then I can move this box down below where I place my second buy, right? It's the same size, okay? So that same initial 10% chunk, I'm just moving it even lower. So I'm saving this much worth of drawdown just by waiting for it to go lower than the threshold and keep going, and then show me my criteria that tells me there's a high degree of likelihood that it might reverse there, right? Whereas everyone else might buy here, might buy here, might buy here. There are 3 buys in at this point, and I'm just now placing my second buy, and I've got a much wider range of traversal area for my average. So my average can move that much farther down just by me being patient. Okay, so I don't have to do anything crazy here. I'm just gonna look for specific things. So what specifically do I look for? And that's as simple as making sure the price is below this line here, below that 10% threshold, below my zone of opportunity. And then you guys know this and love it. It's the bullish engulfing. All right. So for these, I'm on the 5-minute time frame. It's really just applicable to whatever time frame you're doing your analysis on. I just prefer the 5-minute for these because they're little low float poppers, and if they run fast like this one, I can always take my profits, get back in, take my profits, get back in, so on and so forth, right? And in this case, all I have to do is make sure that the price is in this box somewhere, right? Above 0, below this line, and then I have to make sure that I'm only placing a buy when the price breaks over the open of a previous red candle, okay? So if we go back to yesterday, all right, let's say, I think it was yesterday. Let's say that I took my profits here, right? And then I re-entered right here, right on this buy, this little block right here. Okay, let's assume this is still 10%, okay? This would be my threshold, and I would want to look for a bullish engulf. So I want to see the color change from red to, in this case, white or bullish candle, or green on yours, because that's where I understand that the price is reversing strongly enough to reclaim what the bears have done. So in this case, my second buy in that scenario would be right over a break of that candle's open. So this right here, this candle right there would be my second buy. Okay, so that's my first buy, second buy, and this little zone right here between the threshold and that candle, that actual purchase, that's just extra padding. Okay, so it's extra leverage over my average, and that's what I want. So when I'm doing these, okay, and I see a red candle open below my threshold, I can immediately place a buy stop order, and that's just an order that executes on the way up when the price breaks over a certain threshold. And of course, that only applies during market hours. So if you're doing it after hours, you're going to have to do a limit order. But a buy stop order is perfect because once this candle closes and I know it's red, I can place that buy stop order. And then all I have to do is wait for the price to break over that level, and that's my buy. And it's automatic. I don't have to worry about it. Now, in this case, the price here didn't break over that candle, so I get an even better discount, right? And then the next red candle that closed is right here. So I can move this buy stop order down right there. And then when this price pushes up, boom, I get filled. That's my second buy. And I don't have to think about anything. I don't have to watch it. I just have to pay attention when the candles close and see whether or not they're red, bearish or bullish, and then place my buy. And then, of course, that moves my average down every time. It increases my share quantity, which decreases my average cost per share, which then I move my threshold for my sell order, right? Because I always want it to be 10% for this particular strategy. So in that case, that was hit. It was hit this morning at some point. And it's pretty easy. And then it got hit again because I re-entered, I think it was this day, yesterday. Yeah, I think I re-entered, bought, and then it popped up and I took my profits. And again, this morning, Zach and I traded it in the stock chat channel in Discord, and we just traded it. And then I got back in. He locked his profit because he had to go get his car that he just bought. But I'm kind of going on a tangent there. But the strategy is very simple. It's the same thing that I'm looking for. I'm just adding a couple rules to it that make sense. Okay. And the reason I'm doing that is because I want to really force those buys as far apart as possible so that I have maximum leverage over this average. I want this average to be way down here when the price comes back up to my break even. This entire range right here is extra profit instead of me just breaking even, right? So if I buy here, buy down here, and my average comes all the way down here, and then the price comes back up to where I originally bought, that's extra profit range, right? It's not just me breaking even, whereas someone who just put all their money in that one spot would just be breaking even, and they'd be probably pretty frustrated and wanting to sell and get out of that position. Whereas I am already in a position where I could leave runners and just let the price breathe to the upside without having to worry about, do I panic sell? Because I don't have that same stress. All right. So what I'm going to do now is I'm going to pull over a spreadsheet that kind of shows exactly what I look for prices. Okay. So we'll use PXMD as well. I got a master copy here. I just duplicate that. So for example, okay, on PXMD, right here, you can see that my first buy was $83.34, and it was $1,000, which I have a pre-configured template here. So in this case, I'm using 10% drop ranges, and the position size is $16,000, okay? Which tells me, based on this purchase price, 10% of that is this number. It's 0.0833, okay? So that means every 8-cent drop is where the next threshold will be calculated. So if I place my next buy here at 75.01, let's just say that I see my specific criteria right at 75.01. That next threshold would be that number minus that range of 8 cents, 8.33 cents. Okay. However, if I don't see that criteria until 62 cents, let's say the price just falls all the way down here, then I see my criteria, my bullish engulfing candle, and I place that second buy at 62 cents. That pushes the next threshold down 8 cents below the 62 cents because I want this range to be applied to every time I buy. So rather than buying at 66 cents and then buying again at 62 or below, I'm only buying once at 83 cents, once at 62 cents, and then I have to wait until the price goes down below 53.67 in order to even look for another bullish engulf below that threshold to place my third buy. Whereas if I didn't do that and I just bought 10% down, I'd be in my third buy, or my fourth buy potentially at that point. So there is a lot of value in just adding this small extra step into the equation. And as you can see here, like NXPL, for example, these 10% drops really just put me back where the price was originally. So I'm not too upset if this thing stays here for a while, it's a low float runner. It will get a catalyst at some point. If it sells off, I still have this big buy left. If I want to use it at let's say 60 cents, for example, that would drill my average down very, very far. You can see that my average would go from $1.73 down to 99 cents. And then all it has to do is go 10 cents higher than that, and I can cash in and make that $1,500 profit that this would then afford me because I would have that size position. So I'd have 16,000 in there, roughly. 10% of that is about 1,600. So, or no, I'm sorry, this is 15,000. I apologize. But either way, you can see that PXMD, PaxMed, for example, right now, since I just have that first buy of $1,000 and I'm just looking for a 10% profit, it's going to be a $99.92 profit when that limit order fills. Okay, the limit sell order here at 92 cents. Whereas NXPL, I have a bigger position because I've covered it over a wider range. Now this thing started, I bought this at 262 for the first buy. Then the second one was 228, then 204, then 184, then 156, then 132. And now I'm looking for that final buy on the way up, at least below $1.05 or $1.06. Okay, so you can see here, I've just drawn a line where that next one will be, and that'll be my final buy. And if it falls down and I place that buy, let's say I put my final buy somewhere here in the 80s or something, since it's a bullish engulfing, I can set a stop loss right there if I want to, since that's my final buy and I don't want it going down any farther. And that's kind of where I'll see the max loss potential in this, other than maybe a stock getting delisted or something, but that's not going to happen with this one. That's the only time you're really ever going to deal with a bigger loss in this case, and that's about a 30% drawdown. So that's it's a little bit of a heavy hit, but we are trading we're playing the probability game here. right? So the likelihood of any one position doing that and hitting that max loss is pretty low, right? Because most of the time you're just buying these little maybe 1, 2, or 3 buys, and you're just getting those pops, and you're locking the profit and moving on. Or you can always reduce the position size. Like if this one here gets back to break even, I can reduce this right back down to that first buy, and just leave $1,000 in, and just go for that 10% profit on $1,000. So it's very easy to kind of manage these positions, and it really just depends on what your priorities are. If you're someone that doesn't have a high risk tolerance, you might choose to reduce your position size at break even rather than letting it go that extra 10%. Whereas if you have a higher risk tolerance or you're more confident in the trade, maybe you'll let it go a little bit farther and let the full position ride. Maybe you'll also scale out, most of the position here, and maybe leave 1,000 or 2,000 running, or whatever your particular dollar amounts are. Obviously, we're on different size portfolios. And ultimately, what this does is it puts me in a position where I can seek to realize roughly $500 in profits per day on this size account, which is 1% of the portfolio. So again, I'm not shooting super high here. I'm just shooting for 1% of the portfolio per day. Now, in combination with the covered calls, for example, and the other forms of passive income on this portfolio, I'm about $45 short for the week already, and it's Wednesday, right? So Monday I realized a profit of $1,700 or $1,755. Yesterday I realized a profit of $500. Today is Wednesday. I've realized $200, and that leaves about $45 left for the next 2 days for me to realize in profits. And it's just a mix of this speculative strategy on the low float runners that just drop and pop and drop, and these covered calls that are just slowly accruing value over time. And you can see like this one's going to expire Friday, so I put a buy order in for these automatically for $1 just in case they drop really fast, and then I can buy them and open a new one. That's that strategy. And then for the speculation stuff, I'm just doing this. I'm buying in, buying down, and letting things breathe to the downside appropriately, waiting till that breath stops, and waiting for that next cycle of that breath to start again in the direction I want it to go, and giving myself 7 opportunities per buy, or 1 opportunity per buy for that price to keep going up every time I buy an engulfing candle, which is at least 10% down, right? So that's really, really good odds for the price to just reverse at some point. One of those buys is likely to be the bottom at some point. And I can just rinse and repeat this strategy on most stocks most of the time. And the only time it really sucks is if you're in a situation like this where the volume just goes away and then you're just kind of sitting on a flat stock. But that's just one catalyst away from popping again and I can get out. So I'm not too worried about it. It just means I can't trade super aggressively with that money that's tied up or dedicated to that trade. Okay. And again, this is, maybe 1,000 or 2,000 down overall, but we're also sitting on something like this, which all it has to do is get back to break even. And if it doesn't get back to break even, I'm just going to keep selling covered calls and reducing that value, and increasing this value over time. So if you think about it, if I took all this drawdown here, what is this like? I think it's like 16K or something like that, and I added that to my 48K here. That's well over 62K on the portfolio in about a month and a half. All it has to do is come back, right? And most of it is just this NEO position here. So if we look at NEO, right, and this is another reason why I don't really get stressed out over this stuff. I mean, realistically, it's a bigger position in the portfolio, but it's down about 26% as far as the share unrealized P&L goes. But we've also collected several $1,000s from those covered calls to offset that. So eventually this will add up to about 16, and then we'll just be kind of sitting on a realized loss for the shares, but we'll be about break even. So throughout all this nastiness in the market, all this drawdown, all the chaos in NEO selling off about 28-30%, plug down 20%, WBA down 14%, SPCE down 32%, all that stuff all combined is still not enough to drag this portfolio down significantly, and we're still just kind of chilling around break even. So it's not so much gotta trade. It's gotta trade effectively, and then you can trade less. So that's all I'm doing here. I'm not looking at this stock all day. I only really care about what happens when the price gets below this level or above this level. Either way, I'll get a notification because I can create an alarm right here. I could just say this, right? When the price drops below 75 cents, I'll get an alert. Easy peasy. It'll tell me it's time to start looking for that pattern. Until that happens, I don't care what the stock does. It can bounce around between these two for 3 months. I don't care. Because as time goes by, I get these covered call profits just rolling in over and over and over again. Now, some of these are pretty small. Like this is $5. This is $6, you know, times 28 times 2. It's not super insignificant for a lot of smaller accounts, but as far as the overall portfolio goes, it just adds up, right? So again, this isn't where the bulk of the money comes from. It's going to be this NEO growth. It's going to be the recovery of NEO over time. But I can't guarantee when that's going to happen. I just know that there's a lot of potential for it, and I know that we're starting to get some strength stepping in here. I know we had a pretty good divergence setup, and I know that the stock has been pretty beaten down because of certain catalysts in the Chinese government right now. Okay, so the sector itself is struggling, therefore this company is struggling. However, this company also has really good potential. So when this sector comes back, I have no doubt in my mind this one will probably do pretty well. Until then, I'm going to sell these covered calls. I'm just going to sell the hell out of them. So that's what helps me sleep at night. I don't really have to worry about it. So as far as these go, I could consider doing multiple smaller positions and kind of incorporating that into this series if you guys are interested in that. But a lot of these I just share kind of in the Discord. So they don't really require a lot of thought. And if you're someone who's maybe a little more risk averse, you could kick this up to like 15%, for example. And then, oops, sorry about that, 15%. And what that would do is that would just increase the distance between the buys, so even more. So let's say this one I bought for 62 cents. This one I bought for 45 cents or 42 cents. Sorry, I'll do 45. Yeah. Let's say this one I did at 27 cents, for example. Again, just knowing that it's got to go at least below the threshold, and then a bullish engulfing candle on the time frame that I like. And you could see here, if I get down to 12 cents, for example, I won't be able to place my 6th or 7th buy because the price would have to be negative for that to happen. So obviously I'm not going to hold a position with a lot of size at that point because that's just sketchy. If it doesn't belong down there, I will. But if it's been down there and it deflates and goes back down there, I'm not going to hold it. But you can see that just by being patient and forcing yourself to spread these buys apart and then only buying when the chance of that stock continuing in the upward direction, the direction I want it to go, is the highest, and doing that multiple times, I'm going to do pretty good in the market. So again, when people figure out, hey, I don't need to put it all in one spot and hope I'm right and then get a 30% chance that it'll go up, because that's not sustainable. You're not going to win that way. Even if you're doing something crazy like bullish engulfings, unless you use super tight stops and all that good stuff that I've been teaching, even then you might struggle, right? Everyone has different psychology and stuff. But if you could do 7 buys instead, or 5 buys or 4 buys, whatever your strategy is, and they're far enough apart where it's going to move that average down as far as possible, because if you increase the size of these lower buys, that's going to be a bigger drop in the same size bucket, and it's going to push your average down even farther. So this is similar to the martingale strategy, but as I covered in one of the PBA videos, there are some obvious drawbacks to that strategy, so I don't personally encourage everyone to use it. But in the market, we can use that to our advantage and capitulate the max risk, whereas the original martingale strategy, it doesn't work like that. And you will just run out of capital for the same reward of 1 unit. So we can be aware of that stuff. We can take advantage of it, and we can split those buys up. If you haven't done that before, practice it. You can paper trade it all day long. Just give it a whirl, backtest it. Say, if I placed 10% of my position here, right, and then I waited, your profit, if it goes up, that's not going to be that great. However, it's better than a 10% loss in a full position, right? Whereas if you're, maybe it did fall down 10%, maybe it fell down 15% before you saw your criteria, and then you placed another buy, maybe it was 20% of the original amount, and then it goes back up. You're 30% in, 70% of your money is sitting on the side with no risk. You can always use that to lower your average again in the future in a meaningful range. Otherwise, you can just take the profit on that 30% and move on. Just go to the next trade, next trade, next trade. It might not be huge profits, but it adds up pretty nice because your success rate will increase because you're playing the odds at that point. You're not just hoping you're right. So we're not flipping quarters here and hoping we're right. If you are, We can, we can manage our stops nice and tight and all that good stuff, but until you're fully committed, if you're someone that has a higher risk tolerance like me, you don't necessarily need to. We can always just wait until we're fully in and then place a stop loss and have just as much fun with it. And still save on potential losses, because again, if you're only 60% in and then you place that last buy, that last 40% doesn't have the same risk profile. And if you put your stop loss right below it, 40% of your position only has a very tight risk range. So your net loss, even in that case, will be much smaller than if you just bought 100% at one level and let it fall down all the way. Okay? So I got to end this episode here because it's 30 minutes. I know these have been a little bit longer in duration, but I really, really want to dive into these concepts with you guys and show you guys from start to finish how we can use them. Because I want to start incorporating more speculative stuff into this portfolio. And I also want to take advantage of small cap season, which is kind of starting this week, next week. So it's going to be exciting. We'll see what happens. I got to end this recording here. Thank you all for watching, and make sure you have a good day.